let's look at a more recent example. I'm going to go through several of these so you get the idea here. Intel Corp. Here's a chart from 1998 to 2008, and you see what happened. The market jumped dramatically in 98, 99. This was during the dot-com craze, and it just collapsed. Okay, so from the peak, this is a weekly chart, by the way. From the peak, we had initially a 70% drawdown to this level right here into 2000 after the market peaked. And of course, the time to break even is unknown. Here it is, 8 years have gone by, and we're nowhere near that previous peak. So, you know, that's big time risk, right? I mean, if you were still long the stock from 75, you don't know when you're going to recover that money. Maybe never. Now, let's say you bought it in 1998 at 25 over here to the far left side of the chart. And you held it all this time. You would be initially thrilled with this tripling of your money. You had no strategy to get out because you're a buy and holder, only to see the entire profit disappear, and then this thing chops sideways for several years. And as of today, you'd be at break even. That's if you'd have bought it around 25. You bought it at 75, of course, you're not happy at all. And then you can see at successive periods there in red in late 2000. So from this high here in 2001, you know, had you bought there thinking, well, the market had bottomed, now it's going up, it drops down 60%. And it took another 2 years for it to get back up to almost break even before it dropped again. Then this period here, you still can't see the pencil. Oh, you can see the drawing. Can you see that drawing? All right, good. All right, I'll use that, and then that'll take care of it. So here again, right in here, had you bought there thinking the market had not up, it dropped another 45% from here to here. Time to break even, had you bought here? Time to break even's unknown. Now, Intel's a big name company. I mean, this is not a fly-by-night stock. But, I mean, with this one stock, you can see the hazard of buy and hold. I mean, I know a lot of people have Intel in their portfolio. Look at this. Now, what's the alternative? The alternative is to trade it. Well, as I said, you need a good trading method to be able to trade it, because trading is not risk-free by any means. But what you try to do with trading is identify the prevailing trend. You know, in this area back here, the prevailing trend was up. And so what you do then is you look for low risk, high probability opportunities to enter the market with the trend. Now, Bernard Baruch said he just can't help but make money because what he does is he waits for the market to bottom, and then he enters after it moves up. And he gets out before it stops going up. He's satisfied with the middle 1/3. What's he saying? He doesn't try to buy bottoms. He doesn't try to sell tops. Bernard Baruch, by the way, was a notorious successful trader in the early part of the 1900s. But nothing changes. The markets are driven by fear and greed. They were then, they are today. And his advice is good advice, I believe. He tries to get that middle 1/3. Now the trend moves down. Well, you don't know the trends move down until after it has gone through some key support areas, And once you see that, then you can look at going short. But you got to get out before it starts moving up. Here the trend is down again. That was a tradable downtrend. Here's a tradable uptrend. Here's a tradable downtrend. This is not tradable, and it's important to know when not to trade as it is when to trade. Here's a tradable uptrend. Okay, so here's the stock that there was plenty of trading opportunity while the buying holders, had they bought here, are just breaking even, and had they bought here, they're still licking their wounds. Okay, Microsoft. Similar pattern from the 2000 peak, 67% drawdown. Time to break even, still going on, 8 years and counting. Had you bought it up here. Had you bought it down here, 8 years, 10 years later, it's still where you bought it. It's at break even. And then you can see again, it moved up only to drop again, this time from about 37 down to 25, about a 50% drawdown here. And time to break even, 7 years. Finally got back up there and then promptly dropped again. Well, how many people have Microsoft in their portfolio? A lot of people. This is a good company, you know. We all know Microsoft. But it's not necessarily a good stock to have in your portfolio because look at the performance. General Motors, American Icon, peaked out here in 2000 at above 90, dropped significantly, peaked out again, dropped significantly, dropped significantly. So time to break even from all of these peaks, from this peak here, 8 years and counting, from this peak here, 6 years and counting, this peak here, 5 years, this peak here, the last couple of years. This is not a good buy and hold situation. So here's risk as I define it. Remember, the time to break even, 8 years in this case, and the percent drawdown, 75% in this case. Now that's a lot of risk. Here's American Express. A little bit better picture on this one, but still, time to break even from the 2000 peak, 5 years, after a 64% drawdown. Made a more recent peak here in 07 and is now down at least 30%. And the time to break even is a year and counting. And do we need to redline this one? Here's the peak, and it just went down and down and down and down and down from 85, almost 90, all the way down to 20 before it went sideways. A dramatic drop. And time to break even, what's your bet? It's gonna be a long time coming. Eastman Kodak, big company. A lot of people own this stock. A lot of people still own it, waiting for it to do this. Whoops. Is that going to happen? I don't know.